When most people think about buying an investment property, I guess the first thing that comes in mind is that, they're going to buy in individual names. But, not everyone thinks about all of the different angles or different advantages of potentially buying in maybe a trust, maybe a company.
Imagine the tax that is being imposed on his income, up to 45%. But if he purchases the property under the company, what would happen is that all this additional income from the property will only be taxed at 30%.
A good example of somebody who would really need to focus on asset protection is, somebody, for instance, a barrister. If something goes wrong, they really want to have their assets held in a different entity to make sure that they're not personally liable for anything that goes wrong, because the first thing that's going to happen is they're going to take away their family home.
For example, as an individual, I may have a borrowing capacity of $1 million. If you purchase a property under a trust structure, you may be able to purchase properties beyond that $1 million.
When most people think about buying an investment property, I guess the first thing that comes in mind is that, they're going to buy in their individual names. Could be their individual name, could be their name, their partner's name, whichever way they go, but they always think about that as the first option. But not everyone thinks about all of the different angles or different advantages of potentially buying in maybe a trust, maybe a company. So today's video is about sharing some of these ideas. Everyone's circumstances are completely different, obviously, and it really depends on your personal situation. So don't take, this as go and do that straight away. It's more just giving you the information you need. Today I've brought with me Mr. Daniel.
Hi guys.
Daniel's been an integral part of our team for quite some time. He has vast knowledge and experience in banking and finance, and I guess he helps a lot of our customers inherently buy through a trust or a company. So I thought I'd bring him along today to talk about it.
Okay, so when a client purchases a property, there are a few options when they purchase the property under its ownership structure. There may be a benefit to a client to purchase under a trust name or a company name.
And sometimes even, when it's themselves or their spouse,
correct,
they look at different angles depending on, what the property or the big picture. Don't look so small picture. A lot of people think way too small on cash flow rather than looking at, the long-term effects of
correct,
property.
yeah. Because your long-term goal is very important as to what you want to achieve. Sometimes trust might be beneficial to you if you plan to purchase a property and transfer the properties to your children or grandchildren. That's one of the sample of it.
Yeah, so like elaborating maybe the key points.
Sure.
Yeah, we'll start with maybe why do people use this, and as you mentioned, there is, obviously intergenerational wealth, which is quite important.
So I'll keep it into 3 points. The first one is asset protection. I'll tell a little bit more after this. Second one would be taxation purposes. And the last one is to preserve or increase your borrowing power. Let's start with asset protections. In some situations, your accountant perhaps may suggest you to purchase a property under a company name instead of your own names. Now, don't confuse this. By the end of the day, you still benefit from the properties, by the usage of the property. But the ownership itself is not under yours, but under the company.
Yeah, and that could be a company or a trust, obviously.
Trust, of course, yes, yeah, depending on your needs.
Yeah, so I might quickly elaborate on that. Under asset protection piece, a lot of people, depending on their circumstances, they might be, exposed, or it might be in a vulnerable position where their company or their job entails them to be working in, quite risky operations where something could go wrong. In those circumstances, depending on the advice from the accountant, usually they would then look at, a potential structure to be purchasing it in, which will make sure that no matter what happens, that asset that they've purchased is not going to be, lost in the process of something going wrong in their business or in their work life. A good example of somebody who would really need to focus on asset protection is, somebody, for instance, let's give an example of a barrister, for instance, right? A barrister is forced to be a sole trader, to give advice. And if something goes wrong with their advice, where it can be a costly move for whoever they're giving the advice to, they really want to have their assets held, in a different entity to make sure that they're not personally liable for anything that goes wrong, because the first thing that's going to happen is they're going to take away their family home, they're going to take away their investment properties. That's a prime example of why you would be looking at asset protection.
Now, the next one, which is taxation purposes. So generally speaking, if someone is on the highest tax bracket, the person may get benefit when they purchase a property under a company or under a trust. I'll give you one of the sample. Let's say my friend John, and his income is from his salary, he earns $200,000 a year, and he has two properties which generate positive incomes to him. What would happen is that, say the property brings him $50,000 a year, plus his salary, which meaning $250,000 a year. Imagine the tax that is being imposed on his income, that up to 45% on the income tax. But if he purchases the property under the company, what would happen is that all this additional income from the property will only be taxed at 30%, which is the company tax rate.
Obviously, there is income tax, there's capital gains tax, there's tax on multiple levels. So depending on what you're trying to target, your accountant will give you the right advice. Ideally, you have a great accountant who understands property tax rather than just tax itself. It's very, very specific and very different. Maybe an example would be a property developer, right? So a property developer, cash is king. They need their cash to be able to then, because it's defined as a business, and there's components of that where they need to manage their cash flow. If they had to absorb all of their profits as their individual name and it was substantial, they're paying that maximum tax bracket. Whereas the company tax rate today is almost close to half of what the maximum individual tax rate is. Not quite, but almost.
Almost, yes.
So that cash flow that comes back to them, is substantial. Probably another example is, when we're talking towards land tax, obviously state by state, they will have their own rules in relation to land tax. If it is going to be in your individual name, it might be treated differently in one state versus having it in a company or a trust, which may or may not have its own tax-free threshold, or the tax percentage is lower. So that's something that you would have to discuss also with your accountant to figure out.
Yes.
Very specific one for capital gains is you really need the advice around this, because if you have an end goal to sell your property, for example, you knew you're going to buy this property and then you have an end goal to sell the property within a certain time frame, or you might develop it or you might renovate it. There's different trusts that you can buy the vehicle in as well, and they will inherit different tax advantages. So particularly something called a unit trust. If you don't know what that is, do a bit of research and obviously speak to your accountant about it, but that's where there could be huge tax benefits around the sale or the release of assets. Talking on that note, there are lots of different tax benefits, right? Dan told me about some states, right? They have different rules for land tax, for instance,
Right. Again, as Hung said, it might be best to speak to your accountant, but the sample of it, land tax. When you purchase a property under your own names, there's a threshold to it, which is, if I'm not wrong, $900,000.
It depends on state by state, but in some states and territories, every entity or every ownership structure has its own land tax threshold. And land tax goes up by percentages and it gets higher and higher depending on how much land you essentially own. So it's essential to think about these things when you're buying your next property. Example, I personally have purchased multiple properties in one particular state, and I have set them up in 4 separate different entities or vehicles, because I take advantage of the land tax threshold for each ownership structure and also each entity structure. And in some cases, it creates a whole new land tax threshold for every trust or company that you set up.
Correct.
And with that side, then getting I guess I'll almost call it the Bermuda Triangle, all the information gets soaked in with your A team and making sure that everyone's communicating on the same page and the reasons why we're doing it.
Correct,
It's
yes.
all great to have a really complex structure that's going to save you tax, that's going to protect you, but it sucks when I can't get the finance because the lenders won't lend there, right? So you need to get all pillars running together simultaneously. The more complex you get, the harder it is for, I guess, people to understand you. So you really need that team and kind of establish that very early so you can then, take that and, I guess, use it to your own benefit, right?
And we do take our clients to what we call an education journey. We do want you to understand what you're doing. And as Hung said, which structures is better for you. Normally when I assist my clients, I would run the scenarios for them to compare. And again, I would recommend them to speak to the accountant financial planners, which is I will be very happy to work with them as well. And the last one is to preserve your borrowing capacity. For example, as an individual, I may have a borrowing capacity of $1 million, and I will be limited into that $1 million when I purchase a property. In the meantime, if you purchase a property under a trust structure, you may be able to purchase properties beyond that $1 million.
Yeah, so I think this is a really hot topic at the moment. The interest rates are currently kind of the highest they've been in quite some time, right? So what people are trying to do is find borrowing power. And to find borrowing power, a trust could potentially purchase a property and borrow money. Once that trust is what they deem profitable, could be a company or a trust, but once it can maintain its own commitments and it is profitable, that debt that's inside that trust can be ignored for serviceability, which inherently would be able to allow you to borrow, or if you had $1 million borrowing power, as David said,
Yes.
you would essentially have that $1 million back in borrowing power. Otherwise, that existing debt would be serviced with a 3% buffer and your borrowing power will be reduced dramatically.